So the way the system is going to work, everyone will speak, 10 or 15 minutes, something like that. We'll do all the speakers, and we're going to have plenty of time for Q&A. If I may just suggest on the Q&A, I know that there's so many brilliant people here. You have a microphone? There's so many brilliant people here with so much to say. It's always best, I think, in these occasions to, insofar as it's possible, limit your questions to make them as short as possible. I know it's sometimes difficult for me, right? I always want to give a speech when I'm asking a question. So think it through carefully, reduce it into as little time as possible, and let's let the speaker answer the question when the time comes. So the first panel is going to concern money and freedom, an elaboration of what I talked about just today. So, and we're going to go in the order of Kathy Reisenwitz, and then Tour Demeester, and then Doug French will finish. So I'd like to introduce Kathy first. So I met Kathy first at the University of Birmingham, right? You were a student, right? And so it was a funny occasion because I was invited to speak there, and I brought with me the suits from Agora Financial. And I lectured for something like 2 hours, right, on the subject of intellectual property. Oh, it felt like 15 minutes, okay. And Kathy was, I guess, a senior at the time. This is only just a few years ago. And since that time, she's sort of rocketed up since her graduation as a major intellectual force in the world of libertarianism and commentary on social, economic, and cultural affairs. She runs Sex and the State. And, you've actually starred in some media productions, right, and a TV series and several other things. So Kathy is one of the rising stars of the current generation of libertarians, and obviously she's a Bitcoiner. What else can I say? So welcome, Kathy, please.
Wow, this is such an honor to be here. So it may seem a little bit weird to, I wanted to say also, if you want to tweet at me, it's at Kathy Reisenwitz, ChathyReisenwitz. So, it may seem weird to begin a talk at a Bitcoin conference with a review of the scientific method. But I feel like if there were any audience that would at least allow me this, it would be this one. And the reason I think that is because everyone here and everyone who plays with Bitcoin is a scientist, and we're all participating in a great experiment. We all know what an experiment is. We form a hypothesis and we test it. But simple as it is, the experiment is the very best way we have to verify what we think we know about the world. And the world includes currencies. It may seem weird to say it, but I truly believe it would be impossible to overstate the importance of innovation, of the invention of money when it comes to prosperity. By making trade easier, currency fosters the innovation necessary to create wealth. So it's a pretty important thing to understand. To learn about currencies, we have to formulate theories and test them. Now, there are 2 ways to experiment with currencies. First, governments can and do experiment with monetary policy. When it comes down to it, the Weimar Republic was just an experiment. We've seen the consequences of that kind of experimentation. At the worst end, you have Germany, Chile, and Zimbabwe. But not far from that, you have the troubles with the euro, from the riots in Greece to the money grab in Cyprus, which prompted the latest Bitcoin boom. And then you have what we're seeing in America, which is the steady erosion of wealth through monetary inflation. Not only does inflation slowly eat away at individual wealth, but it also disincentivizes savings. And without savings, there's nothing to invest. So then without real savings, investment requires more quantitative easing, which begets more inflation, and the cycle continues. But on the other hand, individuals can experiment with currencies themselves. In this case, fewer experimenters lessens the fallout of a hypothesis not supported by the evidence. In addition, instead of creating victims like government experiments, everyone participating in these experiments is a volunteer. This, in essence, is Bitcoin, and this is why we're all here. Like good scientists, each one of you came here by asking a different question about currency. Can an online currency offer anonymity but still be trustworthy? Can a free market currency keep or increase its value? Can I trust an algorithm to limit inflation? Will an online currency lower transaction costs? Will it allow retailers to avoid paying credit card and debit card fees? Will wildly fluctuating value make an online currency unusable? Then we read up on the problem that we wanted to solve in order to see if Bitcoin was a good way to answer these questions. Then you used Bitcoin to experiment. You saw what happened. You wrote about the results. You tweeted about them. You created MOOC courses about them. You created conferences, all to share with the world the valuable information that you were learning about currency. And yet, even though these experiments were completely voluntary, even though they yielded incredibly useful information, and even though you were incredibly generous with sharing that information, some people have tried to keep you from experimenting. One Bitcoin user created an exchange which completely solved the problem of violence in the drug trade. He created the eBay of narcotics, and in doing so, replaced broken kneecaps with bad user reviews. Instead of armed robbery, he made sure that the Bitcoins weren't released until the goods arrived. But his invention has been forcefully seized. His customers have been dumped back onto the streets, and in the process, they've seized more Bitcoins than ever before. Even before that, they've seized the assets of your other exchanges. They've intimidated your nonprofits with threatening letters, and they've threatened to tax you, and they're still looking for ways to regulate you. Governments try to control currencies. With all that power, shouldn't they seek to learn as much as possible about them? Why would anyone attempt to kneecap thousands of unpaid volunteer experimenters who are constantly sharing with the world what we're learning about how money works? It's really odd. It's almost as if they're more interested in making sure they control the experiment than in what we can learn from it, which is unfortunate. Because when used right, trustworthy, flexible currencies facilitate investment, innovation, and ultimately prosperity. But when misused, currencies bring ruin, stagnation, and poverty. Figuring out how to use money is so incredibly important, and it's much too important to let petty politics, turf wars, and prohibitions halt progress. Earlier, I called you all scientists, and like all scientists, you need your materials, your variables, and your constants to experiment. But that's not enough. You also need the space and freedom to experiment. That's what's threatened by taxation, regulation, and intimidation. My purpose here is to first emphasize the importance of what you're doing with Bitcoin. I truly believe you are early pioneers who are making the world a richer place. But I also want to motivate you in joining the fight for the freedom to continue doing it. Because it's truly up to us, the people who understand what this knowledge can do for the world, to fight for the freedom to continue to find it. So please join me in the fight to keep Bitcoin free and legal. Thank you.
Talk, Arthur. Actually, you described yourself as Arthur. I said, but that's not what your name is. Your name is Tour, right? But anyway, I'll let you introduce yourself.
Yeah, so in Anglo-Saxon territory, I always call myself Arthur. It's Tuur apparently is hard. So I run a financial newsletter, and I've been racking my brain the motivation to start the newsletter was that I've been racking my brain a long time on how to protect myself and other people against the problems, the insolvency, the inevitable crises of the financial system. And so that brought me on the track of first precious metals and then later Bitcoin. And I was thinking for a while about what I was going to say here today, and I cooked up some ideas, and it was going to be, Austrian, and it was going to be like about certain inevitabilities and fallacies, and about the 4 rationalizations of theft by government and how Bitcoin. Well, anyway, and then I decided to throw it all away and start again. And that was after I went to the Bitcoin conference in Amsterdam last week, because I realized that it's very tempting for me, it's very tempting to kind of see an economy or a budding economy that Bitcoin, the Bitcoin ecosphere is, as something like a machine, and then there's just, if we can just kind of forget all the fallacies, then it's just gonna run and zoom us into the future. But then when you're at these conferences and you talk to the entrepreneurs that are actually building it, you realize it's not really the way it works. I mean, there's a lot of imperfect information, there's a lot of darkness they're entering, there's a lot of new things they're exploring, and they're building this brick by brick, and mistakes cost money. They can even cost you your freedom in this era of over-regulation. So that's why I decided to try and bring something today that's a little bit more tangible, hopefully a little bit more useful as well to the entrepreneurs, because we are building a new paradigm, and that means that maybe the old rules don't always apply, and maybe we need to think about new ways of doing things. So that's as far as my introduction goes. I want to open up by saying something about how it seems clear that technology these days is helping us expressing ourselves as individuals in an increasing fashion. There's a lot of technologies that support decentralization, and that basically means that individuals have more space to move. They're no longer under the authority of a central place. Examples are the internet. The size of the internet today is 4 zettabytes, which I have no idea what it is, but it basically means that all the information contained in the books of the Library of Congress fit about 400 million times in the internet, and that's available to billions of people today. So that means that's empowering billions of people today, this decentralized network of information. Open source projects, they've exploded in the past few years. Open source projects are basically tools, technological tools that are available for engineers, developers, innovators, entrepreneurs, and they're the shoulders on which these entrepreneurs can stand to build something new entirely for their own local communities or for a global audience. It doesn't matter. They don't need to pay fees to get some kind of license to get access to the specialized tools. It's just out there, it's available for everybody. So that's the decentralized nature of open source projects. Then there's areas like 3D printing, for example. It's still very young technology, but basically this is the decentralization of manufacturing. And what I've presented here is the amount of designs that are available, open source designs that are available on a website called Thingiverse. Anybody in the world who has a 3D printer, and they're becoming cheaper by the day, can download these designs and can print out whatever machine or whatever statue, whatever kind of useful tool that is embedded in those designs. Cryptography, I think, is also a technology that empowers the individual, because it allows you as an entrepreneur or as an innovator, as a business, to kind of defend your own independence, to enforce a limit between the information you want to keep for yourself and the information you want to hand out. Also, if you want to protect the privacy of your customers, for example, without having to resort to government privileges or to the violence that's provided by some kind of legal system or a police system. You can enforce it just by mathematics. And these numbers, what you see here, are the results of a survey amongst businesses asking them about the use of cryptography. So you see it's actually rising every year. More and more people are using it. And the final example I want to give is crowdfunding. It's also a very embryonal industry, but it's growing so fast. Basically, it means that entrepreneurs no longer have to resort to just a single source for their funding, but they can actually ask the public, ask their future customers, would you like to invest in me, and then I can build something great, and then I can give value back to you. The last example I read, I think just yesterday, is in Holland, where 1,700 families decided to co-fund the construction of a windmill. They raised $1.3 million in just 13 hours. and it's going to be constructed, and it'll provide energy for them. There's many more examples. You can look at energy production with windmill technology and solar especially, that's empowering individual, local production of energy, and also education, for example. I mean, the revolution in e-learning is amazing. It's growing by the last measures I saw, by 23% every year. And if I'm right, then the e-learning space should overtake the state-sponsored education by in 17 years from now, if the present trend continues. That's quite exciting. So we have all these evolutions towards decentralization, empowering of an individual, but at the same time, we have this growing bureaucracy that's encroaching upon our privacy, that's intimidating us in an increasing fashion, and you can even use numbers to back that up. I mean, this is how much governments are taking of the economical pie every year in percentage of GDP. I could show the graph of any Western country and you'll see the same. So governments are growing. So basically, there are these two trends that are going the other direction, and I'm sure you're all convinced as well that the trends towards decentralization is unstoppable, but government is kind of a dead weight now, and they're holding us back. And the reason, I believe, one of the main reasons is that they control the monetary system, they control basically 50% of every transaction, and the financial system has become a subsidiary to this monetary collectivism. This is I don't know if you can see it very well, but it's the US financial industry as a percentage of the market cap, so the total. So basically now 1/5 of the entire economy is gobbled up by this financial industry. And this in a time of, amazing digital possibilities. Still, it's taken up so much of it's consuming so many economic resources. So it's really holding us back. And what is the answer to this problem? I think, in my opinion, is very clear. Bitcoin is an amazing answer to this. They call it the honey badger of money because it's so versatile and powerful, and it doesn't care about what anyone thinks of it. It just does its thing. I think Bitcoin is revolutionary because it's so much in sync with current technological trends. I mean, it's mobile, it's open source, it's peer-to-peer, cryptographically protected. So it has everything it takes to bring us forward and to create an actual alternative financial paradigm. At the same time, I mean, it's only been not even 5 years since Satoshi's paper was published. The anniversary is coming November. So we have a very young market. If you look at where the main activity is in the Bitcoin economy, you're looking at Bitcoin exchanges, you're looking at people building the hardware infrastructure, which is Bitcoin mining, and then you're also looking at gambling and some consumer-oriented industries like the e-commerce, basically. So those are the most important areas right now. But if we want to build a real new financial paradigm, there's a lot more that needs to happen. And there's some daring entrepreneurs that are really actually helping to build that. There are, for example, a couple of Bitcoin-denominated stock markets already. The value of all the Bitcoin-denominated stocks are over $200 million right now. And then there's also some entrepreneurs that are building a credit market. Example is BTC Jam. Actually, I had the privilege to meet Celso, who's a Brazilian entrepreneur that runs it. And they provide a marketplace for credit. So people can go there. They have over 3,000 active users, 10,000 people signed up. And people that have Bitcoins to spare can go there and buy bonds. And other people that need money can go there and ask for a loan. You can have collateralized loans. You can build up your own reputation on the website. So it's very nifty and it's developing still every day. At the same time, they have some challenges because, as you know, Bitcoin is very volatile. And that means if the value of Bitcoin rises, well, the risk for that the counterparty of the bond is going to default increases. And if you're a lender, that's kind of dangerous. Maybe it'll go up 3x in a month, and then you won't be able to pay back the loan. And then there's also the susceptibility of fraud because basically you're sending this e-cash to the other side of the world, perhaps. And despite whatever this person is doing to build an identity online, he might just run away with it. So that's why I wanted to introduced this new idea that I was introduced to by Jim Burton, who's the developer behind Multibit. Multibit is one of the more popular lightweight Bitcoin wallets. Jim is one of those, I'm sure you've met them as well, but one of those Bitcoin polymaths. I mean, they're both programmers and then philosophers, and turns out they're monetary historians as well. Because he taught me something I had never heard before, and that's the concept of the real bill. This is a kind of a contractual technology that's been around since the 14th century in Italy, and it developed since. And there's actually historians that say that the British Empire would have never been able to grow this vast and great without the use of this technology. So let me just briefly introduce the concept by an example. So imagine that I'm a humble baker and I bake bread every day, but I have increased demand, and so I want to expand my business and I want to buy more flour to do that, but I don't have the money available right now. So what I do is I go to my, my co-citizen, who is Bill the Miller, and he obviously has flour available, and I ask him whether he could provide me a sale on credit, which means, for example, he provides me with 2 tons of flour, and instead of asking the money right now, he'll write a bill that says, I hereby provide 2 tons of flour, and I demand that 60 days from now, I am paid this amount of money from Arthur the baker. And so the bill is signed by the two parties, and that's that. And then he just waits for his money. And we have to know as well that usually the person, the lower order good producer, which is the flour provider, usually puts a little premium into the price to compensate for the fact that he has to wait for the money. So maybe instead of $1,000, he'll ask for $1,050 to be paid. So that's a scenario. But an alternative is that the miller actually needs money. He needs money right now because he has some bills to pay. So what he can then do is decide to sell the bill into the market. And because that allows him to get the money right now, he can sell it for a discount. So maybe he'll only ask $1,000 for the bill. And that means there's a profit incentive for investors in the market to buy a bill for $1,000 and then 60 days later go to Arthur the baker and ask for $1,050 back, right? And so, to summarize, what a real bill is, or a bill of exchange, is it's a sale on credit. It's the payment is due on a definitive date. Usually it's used for high-demand consumer goods. The debt that it represents is extinguishable, so after the 60 days when the payment is done, you can actually just destroy the bill. There's no extra liquidity that's entering the system. It's bottom up, so it's driven by consumer demand, and the contracts are tradable. You can build a secondary markets in which these basically futures contracts can circulate, and that's also what I understand from it that happened historically. So the advantages of this system is that fraud is less likely, because if I want to defraud, it's kind of difficult for me as a baker because I already have a business, number one, and number two, I'm receiving payment in kind. So it's quite hard to run away with 2 tons of flour. You know, it's harder to run away with that than with just some bitcoins for a loan. It's not inflationary because there's no new money entering the system versus, of course, the fractional reserve system we're used to, where banks just create money out of thin air and then they provide the lender with that, and then they're paid back, and then it just keeps circulating. So it drives up prices among the economy. That's not true with real bills. The secondary market, I talked about that. So it's possible to actually create a quite sophisticated ecosphere that would provide credit to actual producers. And then there's also the fact that the system of discounts I was explaining. So when the emitter of the real bill has a need for money immediately, he can give a larger discount. So that's a way to coordinate the allocation of capital in the economy. That might be, in some occasions, more efficient than just having like a general interest rate. So what I'm suggesting here is not at all to make this the future and to kind of discard traditional lending and traditional bonds. Not at all. I'm just like humbly suggesting that maybe this is one direction in which the Bitcoin economy, one possible solution the Bitcoin economy could embrace if we are to build a truly alternative financial paradigm. And I'm really interested to, if there's anyone, there's surely many more people with more historical knowledge about this, or entrepreneurs that have ideas on to do something with it. I'm excited, I want to learn more. Maybe I've said some things that are plainly wrong. If people have ideas on what to do with it, come talk to me. I don't have much more to say, actually. I have a website. There's nothing much there, but I'm working on an English version of my financial newsletter. I don't have an exact date for when that's going to come out. I'm on Twitter as well. If you have questions, always send me an email, or of course we can talk here at the conference. Thanks.
Next, I'd like to introduce Doug French. Doug French was for many years a banker in Las Vegas and knows very well and understands real-world banking institutions in a way in which most Austrian economists don't have any experience in. So while he was in this profession, he studied under Murray Rothbard, which is a fascinating thing. He did his master's degree under Murray, and has long been writing on and reflecting on the relationship between theory and practice. So I'm pleased that he's going to be addressing this question today. Doug French.
Thank you, Jeffrey. Thank all of you for coming to Atlanta to the first cryptocurrency conference. It's been quite an undertaking, and Arlene has done a lot of work, as has Jeffrey, and it certainly paid off with your attendance. As one of the older guys in the room, it seems like all the old guys are coming up and talking to me, which is nice, because they think we maybe have something to share. It's interesting that I was thinking last night that I probably should be disqualified from speaking at this conference because I've lost the Bitcoins that were in my phone. And I asked one of our presenters last evening if he could help me find them. And he told me, in the end, no, I think they're gone. And thank you for making my Bitcoin more valuable. You know, I share an office with Jeffrey, and when Jeffrey gets obsessed with something, it really takes hold. And when he sunk his teeth into Bitcoin and was writing seemingly a piece every single day on the subject, he of course was he was transferring dollars into Bitcoin. And the Bitcoin price began to rise. And that's all well and good, except that he needed to give me an update every 15 minutes of how much money he had made. And frankly, I got sick of Bitcoin. I was like, enough Bitcoin already. I've had it with Bitcoin. But I think what was interesting, we went to Liberty Fest this year in Las Vegas, and we had a panel that Jeffrey was very instrumental in talking Mark Skousen and Tammy Holland into having a Bitcoin panel, of which he and I and a couple others were on. And when you get around gold bugs, which inevitably you do at an event with a lot of hard money investors, it occurred to me, we had a packed audience, by the way, for our Bitcoin session. People that were very deeply interested in this, but ultimately gold is what they are interested in. And I'm somewhat of a gold bug, I suppose. And gold bugs have this fantasy that the US dollar is ultimately going to crash. And at that point, us gold bugs are going to reach in to wherever we have our Krugerrands and our eagles hidden, and we're going to get handfuls of them and stand in the street and go, I was right. I told all you people I was right. So that's the kind of the gold bug fantasy. But then I was thinking in relation to the Kindle that I had taken to Las Vegas to read. And my Kindle has 200 books on it. So essentially, I take a library wherever I go in the world, and I can pull up these books and read them. And it occurred to me that essentially Bitcoin is the monetary equivalent. You know, gold is great, and gold was wonderful when we lived our lives in a 10 or 20 or 15 mile radius. Hauling a few gold coins around was not a bad, that was okay. But sending gold overseas, sending gold even, across the country is somewhat unhandy. And I think that the idea that we are going to devolve from a U.S. dollar fiat currency or euro or what have you, we're going to devolve to the point where we go back to hauling heavy coins around. I just don't think that's the way the world is going to work. And it was at that point that Bitcoin just hit me square in the face. So what I wanted to talk about today was about banking. And frankly, I'm not sure what banking would look like in a Bitcoin world. But there's a gentleman by the name of John Carney who writes, he's a senior editor for the financial television network CNBC. And possibly some of you read his blog. At least maybe you read this blog. His blog is called NetNet. And by the way, I pay attention to John Carney primarily because he pays attention to me. Anybody that follows me on Twitter, must have something on the stick, however misguided they may be. And so, but he's very sympathetic to the free market, and he's very sympathetic to Austrian points of view. But he devoted a recent column to the idea of fractionalized banking in Bitcoin. He said it was very, very possible. And he started his column by saying that many people have said that one of the advantages of Bitcoin is that you could not have fractionalized banking. You could not create new money through the Bitcoin system. And he disagrees. He writes, whatever the merits of the argument, however, it is just not true that there can't be fractionalized lending in Bitcoins. He says, I imagine I set up a Bitcoin bank. I offer to store Bitcoins on my secure servers where they are less likely to be lost or stolen than if they were kept on your laptop. Let's say 100 Bitcoin users decide to bank with me, collectively depositing 100,000 Bitcoins. This is accomplished just like every other transfer of Bitcoins. Well, yeah, except transferring Bitcoin is different than depositing money in a bank. I mean, when you transfer Bitcoin, just by the near nature of doing it, you know that you don't have the use of those Bitcoin anymore. But when you deposit money in a bank, if you go put $100 in your favorite bank down the street, you assume that $100 is yours to use. It's $100 that you can write checks on. It's $100 that you can write checks, either write checks or transfer or come and withdraw it at any time. You have not given up the use of that money. But when you transfer Bitcoin, you know that you've relinquished the use of your Bitcoin. They believe their money is available to depositors. Believe that their money is available to them at all times. That it's their property. When you transfer the Bitcoin, you know that the banker now has the Bitcoin, and it's for them to do what they want. Now he goes on and he says, I have 100,000 Bitcoin, can I lend these out? He says, of course I can. He says, I could even require banking with me as a condition of getting a Bitcoin loan, which would mean I don't even need to transfer the Bitcoins when I make a loan. What he's talking about here is creating Bitcoin substitutes, similar to the idea of making monetary substitutes. But there isn't a need to make monetary substitutes. There used to be a need for making monetary substitutes when money was gold. It was unhandy, as I said earlier, to haul gold coins around, so people would put gold coins in a bank and they would get a receipt for those gold coins, and then the receipts would then trade as money because it was easy for them to transfer. That is not a problem with Bitcoin. We can kiss our phones together and transfer Bitcoin all we want. It's not a problem then to work with Bitcoin. So what we have in the case of Carney's, and he goes on to talk about how much he could lend, and as long as he doesn't get a run on his Bitcoin bank, as long as he can get more deposits of Bitcoin in, he's going to be, it's all going to be well and good. And what he is describing, of course, is fractionalized banking. But when Carney lends Bitcoin, he has loaned a specific property to someone else. It's what Jeffrey described earlier. Bitcoin is specific property. It's money that's rooted in property values. The owners of Bitcoin retain that ownership. If they transfer it to the bank, they've relinquished that ownership. Two people cannot own the same Bitcoin at the same time. I think we have a few miners in the audience, right? We have some miners. Can two people own the same Bitcoin at the same time? Yeah, I get a little like this. Right. I think that's the whole idea Satoshi set up with his system, is that you can't have two people owning the same asset at the same time. In traditional banking, when you put $100 in the bank, you own that $100. But the bank has taken at least 90 of it, and maybe 100 of your $100, and lent it to somebody else. So you have two people owning the same asset at the same time. That's how money's created in the fractionalized banking world. You can't have that in the Bitcoin world. Or maybe you can with this little, but we'll get to the questions and you guys can tear me up on this later. Because that's what this conference is all about. We say things and then you tear us up later in the Q&A. So it's the mining community that is the judge and the jury and are collectively interested in protecting the integrity of the Bitcoin currency. Not only that, but they're also interested in protecting property rights. Individual judges in the past, not so much. Fractionalized banking says that precedent rests on 3 court decisions. And the first case was in 1811. It was Carr versus Carr. And the court had to decide whether the term debts mentioned in a will included a cash balance in a bank deposit. And unfortunately, the master of the rolls, Sir William Grant, ruled that it did. Grant maintained that since the money had been paid generally into the bank and was not earmarked in a sealed bag, it had become a loan rather than a bailment. In other words, that deposit had become the bank's property. 5 years later, there was a follow-up case. This was challenged again. So this would have been in 1816. Devanes versus Noble. One of the counselors argued correctly, a banker is rather a bailee of the customer's funds than his debtor, because the money in his hands is rather a deposit than a debt, and may therefore be instantly demanded and taken up. But the same Judge Grant that had ruled 5 years before again insisted, in contrast to what would have been happening later in the grain warehouse law, that, quote, money paid into a banker's becomes immediately a part of his general assets, and he is merely a debtor for the amount. So in other words, people who think they're deposited in banks are essentially loaning banks money. There's a big difference, but I would contend that most people don't realize as a depositor that you're lending the bank money for them to do whatever they may do, whether it's buying mortgage-backed securities or lending on real estate projects or making a car loan to your dodgy brother-in-law, whatever it may be, that's what you're doing. In 1848 was the third case that was instrumental in the bankers being able to do what they want with your money via fractionalized banking. And Lord Cottenham made his decision lucidly, as Murray Rothbard put it, or if incorrectly and even disastrously, money when paid into a bank ceases altogether to be money of the principal. It is then the money of the banker, who is bound to an equivalent by paying a similar sum to that deposited with him when he is asked for it. The money placed in the custody of a banker is, to all intents and purposes, the money of the banker, to do with it as he pleases. He is guilty of no breach of trust in employing it. He is not answerable to the principal if he puts it into jeopardy. If he engages in a hazardous speculation, he is not bound to keep it or deal with it as the property of his principal, but he is, of course, answerable for the amount because he has contracted it. In other words, the banker can do what he wants with your money as long as he can replace it later. Now, the difference, and essentially it comes down to this fungibility argument, which I think is very important to some people in the Bitcoin world. But I would contend that each Bitcoin, even fraction of a Bitcoin, is unique. So if Carney's Bitcoin Bank's holding your Bitcoin, I believe Carney's Bank is holding it as a bailment. And for a Bitcoin bank to have control of a depositor's Bitcoin, they would have to possess the depositor's private key to transfer ownership of the Bitcoin. The Bitcoin owner did that. He would be doing it consciously. You would be doing it as a loan. You wouldn't be doing it as a deposit. You would become a lender, not a depositor, knowing that he has given up the use of their Bitcoin for a certain period of time. I can't emphasize this enough. As a depositor, you do not believe you've given up the use of your money. Yet the banker has taken your money and lent it to somebody else for their use, which that person puts it in the bank, and that bank lends it out to someone else, and this is how money is created in the commercial banking system. So contrary, now with dollars, there's no difference between one and the other, so it's easier to make the case, although I don't think it's a good case, that these dollars are fungible and there's no depositor has the right to certain dollars that he deposited. But I think Bitcoin is different. Each one has a unique code assigned to the owner. Each and every transaction has a record. It's been authenticated. And so contrary to Carney, for Bitcoin banking to be legal and ethical business, the owners of Bitcoin must relinquish the use of their Bitcoin to borrowers. Thus, they become willing and conscious lenders instead of unknowing depositors in a fractionalized banking system. But it comes down to it, I think Satoshi is smarter than Carney. You can't have fractionalized Bitcoin banking. Bitcoin protects property rights. That's why it was created. That's why it's a sound currency. Fractionalized banking actually contradicts property rights. Bitcoin banks in the future they'll have to make money from things like secure storage, facilitating currency exchanges, underwriting offerings, those who wish to lend Bitcoin consciously, and those who wish to borrow. But it was Satoshi who made certain that banks in the Bitcoin age would have to make their livings honestly instead of the current banking system that makes their money through embezzlement. Thank you.
2 minutes now, about 15 minutes for questions and answers. I'd just like to kick it off here. Kathy, if I can just present the first question from me to you. What is your sense among people of your generation? What is your sense of how people your age and students just now entering the workforce are responding to Bitcoin and its alternative and its potentials? And what do you see as the barriers to adoption?
I'm seeing a lot of interest among young people in figuring out what's going wrong with our money. I think if you look at the success of the Ron Paul candidacy among young people, oddly, his two big issues were peace and sound money. And I think that young people especially are really interested in how is our monetary system going to be functioning going forward? How can I build wealth for myself when I'm in a lot of debt now? How can I save when the Federal Reserve System is disincentivizing my savings? And so I see a lot of people looking for alternatives. I think that, as has been mentioned before, ending the Federal Reserve is great and gold is good, but it's obviously not enough. And so I think there's interest in Bitcoin and cryptocurrencies as an alternative to that. I think the big barriers to entry would be just how technologically savvy that you need to be to get started, but I think that those barriers are coming down as people see profit in making it easier for people to adopt it. Does that make sense?
You do a lot of writing on illicit markets, right? So what to your mind is, how should we evaluate the relationship between cryptocurrency and things like black markets and illicit sex trade and that sort of thing? What's your sense of that?
I think that you actually see a lot of innovation in black markets because you have high risk, high reward, and it's kind of the same people, I think, who are attracted to black markets are attracted to new innovations in currency and other situations where, early pioneers in Bitcoin were taking a big risk in their time and in their money and their energy, and it paid off for them. And sometimes it doesn't, but they understand that, so they're willing to get involved. So I think any kind of high-risk, high-reward innovation is going to start out in kind of that risky, maybe black market area, but then as it proves itself, and a lot of currencies haven't, but as Bitcoin has proved itself, then it starts to move into a more white market area.
And you can address, one person on the panel or everyone.
For Douglas French. If I'm understanding what you said correctly, and I'm probably not, are you saying that gold is fungible and that 1 ounce of gold, assuming there's no collectible quality to it, 1 ounce of gold is worth another ounce of gold? And Bitcoin is fungible, but it's fungible in a different way. One Bitcoin is worth the same as another Bitcoin. However, there's a second component in that it has its own key that belongs to a single person.
Yeah, I think that's right. I think that, and I actually made a copy of a chain of emails yesterday that was talking about this. Evidently, some people have donated some Bitcoin to the Silk Road address, so some people are getting kind of a big bang out of that. But as a part of that thread, they were talking about fungibility and how important it was for one that Bitcoin be fungible. But I would almost say be careful with that in the sense that I think if this does get down to when there is talk of fractionalized banking in Bitcoin, if you can make a case from a legal sense that each Bitcoin is unique because of the way it's created, yes, it's fungible, but yet identifiable. And I think that makes a much stronger argument instead of the court decisions that went against sound money or sound banking hundreds of years ago. I think that the view should be that, yeah, all Bitcoin are maybe created equal, but that they cannot be identified individually and that these deposits should be bailments instead of just property of the bank so that the banker can do whatever they want.
Hi. Sorry for my language, but I want to clarify several points. One key can belong to multiple persons. So this way, one Bitcoin can belong to multiple persons, but only one person can spend it. And after that, the rest of keys becomes invalid. And second thing is banking with Bitcoin. If offer the value of bank is additional security for coins. In order to be able to provide additional security for coins, you should transfer your control over these coins to the banker. If you will not transfer this control, the security depends on your storage. So, as far as you transfer control, you're creating new coin. It's how protocols works. So it's no more identifiable as the same minded coin.
Okay. I don't really have an answer to that. If you ask me really hard questions, I'm going to be stumped, and I'll just tell you that I am.
Hello, how are you guys doing today? Thanks for coming. Really like to hear what you guys have to say. My name is Sean Wilkinson. I wanted to expand a little bit more about what you were saying. So you said before it's not really possible for two people to own one coin. Well, it kind of is. It's a very little known technical thing. It's really not out there. It's just called.
Well, make it go away, for crying out loud. Fix that.
So it's multi-signature transactions. It's basically, you need two people or any number of people to be able to send that coin out. Mm-hmm. So if you have this process where I give my coin to this bank or whatnot, but they also need my authorization to send it out or use it, or vice versa, could this system actually work? Do you think I would be able to work out it? Do you think work out the technical?
Well, I think people, yeah, I think it could work, but I think, again, consciously, again, people, it is still in control of the person whose Bitcoin it is, correct?
Say that again?
It's still in the control, the Bitcoin is still in the control of the person who owns the Bitcoin.
Well, under this particular protocol, there's someone probably who could explain it better than me, that you would actually need two parties to agree to send that
Mm-hmm.
coin out or send that transaction.
Mm-hmm.
So again, one party could be me, the other party could be the bank. So necessarily when I give that value to them, they can't necessarily do as they please.
They can't do it by themselves. They need you to sign on. And that, I guess that was my point, is that then people become conscious lenders. They consciously have given up control of their Bitcoin, presumably for a contract to receive remuneration later with interest, I assume, or a profit motive on top of that. The distinction I guess I'm trying to draw is that when people put money in the bank, in the banking system now, they are essentially lending money to the bank, but they don't think they are. They think the bank is holding their $100 there and that they're going to guard that with their life. Well, they're not guarding it with their life. They're lending it to some yahoo down the street who may or may not pay them back. And the question is, if there's a run on the bank, are they going to be able to come up with enough liquidity to satisfy their depositors? It doesn't take much to take a bank down. In the case of Washington Mutual, for instance, a run of about 6% of their deposits took them down, to the point where it pushed them into the arms of JP Morgan Chase. I don't anticipate that happening in the Bitcoin world, because for the very thing you're talking about, people have to consciously say, yes, one person has control, and then they need the other person to sign on to that. And that gives us some safeguards against this money creation apparatus that is totally in charge of the banker. They were given carte blanche to do this back in the 1800s with these court cases. And in one case, they made that call just because the deposit was not in a single sealed bag. So judges have worked overtime and bent over backwards to protect the banker's interests. I don't think the mining community is going to do the same thing for Bitcoin banking interests.
And Doug,
but I could be wrong.
But Doug, the point is that under fractures or breaking, you're creating multiple titles for the same piece
You're
of property.
creating multiple titles
which
for
is physically impossible with Bitcoin.
And I'm not talking about, ultimately, I'm not talking about two people owning the same asset at the same time, probably up to 10 people owning the same asset at the same time. And I think it'll be very difficult. Possibly, I'm sure there's people in this crowd who are probably already trying to create ways to do this, and it may happen. But I think I think Satoshi created a protocol that's going to make that very, very difficult, at least initially.
We've got about 3 minutes, so yeah.
Good morning, and thank you for being here. My question is this. Benjamin Losky, the New York State Financial Director, is willing to make new rules for Bitcoin if we're willing to give up some of our transparency. How do you feel about that?
Yeah, it is clear that legislators are pushing for that, more transparency, less privacy, basically. They want to kind of work on the pseudonymity issue. I think it's going to be hard to turn back some of the qualities of Bitcoin, the points that actually attract people to it. But what I do think it's that, at least for the time being, it seems plausible or possible that the desire for Bitcoin core developers, Bitcoin Foundation members, or Bitcoin enthusiasts in general to appease governments is going to result in a slower or a stall in the addition of new elements that introduce more privacy. There was, I don't know if, well, probably most of you are familiar with the concept of zero coin, for example, which is basically an extension on top of the Bitcoin protocol, which allows for more privacy. I don't think it's likely that's going to happen soon. And if it were to happen that core developers and most of the Bitcoin miners are persuaded to kind of allow for less privacy, like change rules so that more transparency is possible, then I think actually we're going to see a fork, and we're going to see two Bitcoins. We're going to see the kind of top of the iceberg official Bitcoin, and then we're going to see another Bitcoin that's much larger, and that's actually less transparent because that's the way people want it. They want their transparency, they want their property. So that's a possible future that I see as far as legislation goes.
You know, just real quickly on the anonymity point, nobody should apologize for the anonymity or pseudonymity or whatever you would say of Bitcoin. The purpose isn't so that people can sneak around and do, illicit, dangerous things, outside the law. That's not the point. The point is that the cryptography that's part of the Bitcoin protocol detaches one's personal identity from the property relationship you have with Bitcoin itself. That's important because right now, like a third of humanity is excluded from the global economy because they don't happen to have credit cards or live near a bank or have a very good reputation. This is just a rotten system. We need to have a money that is detached from our identities and our reputations. It shouldn't always rely on trust. And that requires this, the separation of, I guess you could say, character and ownership or whatever, that we need the anonymity aspects of book. That's an important part of it as an element in liberating humanity from the rotten trust relationships that are embedded in the credit card system that's 60 years out of date. So I don't think any of us should ever apologize for that aspect of Bitcoin. Okay, we've got one more question. Go ahead.
Hi. Hello?
Yeah.
Yeah, my name's Robert Thompson, founder of Zimcoin. I have a question. I love the idea of Bitcoin being related to property. However, with the pervasive and perpetual need of the governments to tax anything from T on, and owning property and their ability to tax that, you don't really own the property, you own it as long as you pay your property taxes. How will Bitcoin escape the historic and pervasive and perpetual need of governments to tax and monitor and control everything? What will keep that from happening?
Well, it's interesting you say that. We've been talking recently that suddenly the government, the United States government, is one of the largest holders now of Bitcoin. So let's just say we got partners. As Garth Brooks would say, we have friends in low places suddenly. And just on the regulatory front, I mean, many people in the Bitcoin world would love to be regulated and they'd love to be taxed because they believe that will give them some sort of credibility to separate themselves from the Silk Roads of the world. I would say from being 20 years in banking, be careful what you wish for. Because it ultimately the Stockholm syndrome sets in. You become very, very compassionate with your captors, and they begin to dictate the business. So, no. In answer to your question, it'll be very difficult to keep government. They know what they have. They know they have an asset now. They're going to be very interested in taxing it, especially when there is some sort of money exchange from Bitcoin to dollars or back and forth, and that's where they're going to try to take their cut. I think it may be impossible to do that, but I leave it to the people in this room to figure out a way around it, so get on it.
Thank you. We'll see you in 15 minutes.